Welcome to Tax Planning Part 2. We're going to continue with what we've covered in Part 1. First of all, medical costs we're going to look for because, quite honestly, this is one I find many clients not understanding completely. First of all, they tend to take the travel expense, but they take it at the full amount for business purposes, and travel expense for medical care is much smaller. Second, they forget about when they go to the drugstore, when they go to the dentist. Those are also travel for medical expense. And there are cases where someone has to go travel overnight because of a medical situation. That is covered, but it's at a lower rate than for others. And the last thing they're going to travel, you got to document it. Now, I suggest to my clients that they have a little notebook that they pay $1.19 for at their local drugstore. And every time they go on the doctor visit, they put down the date, the mileage they left the house or wherever they left, the mileage when they returned, and what doctor or hospital, whatever they saw. That is adequate documentation for the IRS. Insurance premiums paid by the client. Now, if you are having insurance paid by the government or by your insurer, you can't. But if you pay the premiums, and that includes especially the self-employed, they are deductible. In fact, people over 65 who are getting Medicare and they have their own business, they are able to deduct the Medicare expense, which surprised a lot of my clients because I have clients who are over 65 and collecting Medicare. Again, Medicare falls in at 65. For if you're Social Security, it's believed 67 before you get full benefits. Alcohol, stop smoking treatments, and drug abuse treatments. Almost every client I have either in their family or a very close friend done one of these, and they're tax deductible. Now, they have to be a dependent. You can't do it for your neighbor, pay for it, because that would be a charitable gift. But we can do it for our dependents, and that might be a spouse, a child, especially if people have children in their teenagers. Drug abuse and alcohol and smoking all seem to be problems these days, and any treatment is deductible. Nursing home expenses or homes for the aged of a dependent. Your mother is living with you and you can no longer handle her because of her dementia. You put her in a nursing home or old age home, that's going to be deductible. Special schools for a handicapped or mentally disabled child, deductible. And that might be because they got ADD and you don't want them going to regular school because they're filling full of pills, so you send them to a charter school or something else. Charter school would not qualify, but if you went to a special school that specializes in ADD rather than taking pills, that would be acceptable. And I have had clients who do that. Retirement cost. Big benefits for taxes that do you in the long run are very big help, and I think you should really work your clients on using these. Remember that Roth is not deductible, where the other IRAs are. I might warn you that some of your clients may use the post-tax IRA because of the fact they earn too much in their salaries. The post-tax IRAs are not deductible, so it's just a pre-tax. Defined benefit plans taken on your pay are not taxable, and they shouldn't show up in your W-2 as income, so that most people don't even realize that. In fact, the issue comes up when someone says to me, I earned $88,000 last year according to my employer, but I'm only being charged for $82,000. Did he make on my tax W-2? Did he make a mistake on W-2? And typically, it's due to the retirement plan. For lower incomes, if you're 30,000 single and 60,000 married, and that applies to a lot of your children who are graduating college in the last few years, or your clients' children graduating in the last few years, if they contribute to retirement plan under that 30-60 criteria, they get an additional tax credit to $2,000, up to $2,000, so long as they are over 18, they're not a dependent on someone else's tax return, and not a full-time student. So you can have part-time students, such as you. I think you are mostly going to be part-time students, and you're not on someone else's tax return. You're over 18. If for some reason your income is below $60,000 if you're married, or $30,000 if single, you can get an additional tax credit up to $2,000. And again, if you're in a 25% tax bracket, $2,000 is like an $8,000 deduction. And let's say you're in a 10% tax bracket, we'll make it easy, then it's like a $20,000 deduction. So big numbers. Educational expenses. There are many tax opportunities for clients and dependents who want to further their education, tuition and fee deductions up to $4,000 tax credits. Again, these seem to change every other year. They change the names of it. They change what's covered by it. So you really have to look at what year you're looking at, be it next year, the following year, or trying to guess at what it'll be in the future. Some of the tax experts feel that we will see larger tax credits in the future and to encourage people. We also have the interest expense on the tax return for those who have educational expenses for the self or their dependents. And the nice thing about the tax credits we show here, you don't have to itemize to get the credits. Finally, I have on here employee-paid education is a fringe benefit that is non-taxable up to $5,200 and are in addition to the tax credits. So if I can get $5,200 from my employer and I can get the tax credits for the amount up to $4,000, I can probably cover a lot of my education expense, which is very important because once you get in debt on education, it's hard to recover. And I might note that in my experience, people at the university, high schools who are counselors tell the students, get in the best college you can, and don't worry about anything else. Well, as a financial planner, I tell the students, get in the best college you can, provided it's consistent with your educational objectives and your ability to pay back any expenses. So if you're going to become a biotech surgeon or a microbiologist or a lawyer or a CPA or a financial planner, you're going to be able to afford to pay back a college debt. But if you're going to become a social worker or an artist, or you're majoring in German studies or German folklore, then you're going to find that you're going to earn $20,000 or $25,000 a year and never be able to pay back. There was an article in the Wall Street Journal several years ago about someone who went to Carnegie Mellon private school who got a bachelor's and master's degree all on government loans, and she had $125,000 or $130,000 of loans. Obviously, this is a few years ago, and she was earning $20,000 a year as a sociologist. It just doesn't make sense. Had she gone to a financial planner before she did this, or her parents gone to a financial planner, I think that wouldn't happen. They would have sent her to a state school and probably junior college for 2 years. That's why being a financial planner with a huge average income for financial planners, it does make sense to get the loans. Again, you have to look at each case separately. Energy efficient home improvements, again, these change yearly. It's very different between state and federal government, and therefore you have to take a look at each in year and guess at it. But certainly if you then such things as bought a highly efficient furnace, you replace the windows, you replace your refrigerator, etc., I would certainly check to make sure that there's not a tax credit or tax deduction for that. Starting a foundation. Starting your own foundation, enjoying the tax deduction and related benefits is an excellent way of doing it. Some start with funds of $5,000, as I mentioned earlier. However, starting with $500,000 is more reasonable. There's a 2013 tax return that showed $140 million in grants and spent less than $9 million on direct aid. And therefore, they were covering personal expenditures and paying salaries to friends and relatives. And the contributions to the foundation by the individuals were deductible up to the threshold, so which would be, in this case, 20% of AGI. So it's a good way to plan for the future for your children, or give jobs to your friends. If you got large enough, there's one stated a couple of years ago, $300 million that gave like $10,000, and they're all qualified. Again, the IRS, I think, is mainly interested in people thinking about giving money, not necessarily how much they give in these foundations. And let's face it, lobbyists are a big factor, I'm sure, too. Becoming a landlord, is a great way to go, especially if your client has less than $100,000 in adjusted gross income, where they can take up to $25,000 losses. And over a period of time, they build up their equity in the homes, and you can use that for retirement purposes. Or I've personally used rental units for paying off some of my children's education. It's a fantastic income. Obviously, if you're selling investments in insurance, you don't want to push this too hard, because you can't invest in real estate and at the same time invest in stocks and bonds and insurance, because just so much money people have available. But a way around it that makes it attractive for you and your client is they can invest 10% interest in the property. For example, let's say there's a house for sale at $1 million in Lake Arrowhead. A 10% interest in it and a tenants in common with other people used as a rental makes it deductible up to $25,000 losses, as long as it's $100,000. Now, if it's up to $150,000 AGI, they get some kind of a deduction. And remember, not only is the rental income being a cash flow as longer you hold it, it becomes a cash flow capital asset that generates appreciation over time. The thing people forget, and you got to remind the clients this, is that when you sell it, you're subject to capital gains tax. Starting and buying a small business on a part-time basis, great for tax deductions. I encourage many of my clients from financial planning to do this, also for my tax business, because I find that the people who do this tend to get a better attitude about themselves. It's a morale builder. Husband and wife may be having problems, and if they work together in a business, many times it solves the problems. Of course, it can also make it worse, but in general, it does solve a lot of the problems because they're working together as a team. If you get together with other people other than yourself in a partnership or limited liability company, etc., make sure you have diversified skills. If one of you is an engineer, the others should be administrative or marketing oriented, etc. Diversification is key for small businesses. It's great for tax deductions. It makes some of the items that you have taking as a non-taxable today become tax deductible. It's great for the ego. And I found even people who tried a business and failed at it, which many do, they go try again because it was an ego jump. There's potential for growth, again, especially if it's a supplemental job. You might do it on weekends. I had an engineer who on weekends did, he went around fixing washing machines and plumbing, etc., which he enjoyed. He spent all day Saturday doing that. And that gave him a little extra income. And make a long story short, after a while he gave up working for an engineer in the aerospace industry and started his own construction company and did very well for himself. So it's a potential for growth. It supplements income to pay off college debts, buy a residence, etc., and give you more ability to have flexibility with the income and being more able to balance your budget. It requires a great deal of time to develop the business plan over. Too many people jump into business without thinking about it. You really have to take the time to come up with a business plan. That could be anywhere from a few months to a year to really do a good job before you should jump into business. Always also make sure your spouse and other close relatives understand what you're doing, and they might be involved also, which makes it even better in most cases. The Earned Income Tax Credit. Many clients have children who have an adjusted gross income less than $50,000. They may be eligible for the Earned Income Tax Credit. It's very complicated and very high probability of being audited, so the tax return requires a qualified specialist who's approved by the IRS to do it. But certainly it might be your client's parents, it might be their children. $50,000 is a pretty good income, actually, when you think about it. And certainly college students getting out of college are typically going to be in this position. And if they have children, that would be a good chance for them to do it. And most of them don't think about it. They said, I'm not poor, I'm a college graduate. But you qualify. If you qualify, take advantage of it. Summary. In this lesson, you learned about the different ways we can save money for our client. We learned about the methods we can use for convincing our client of the need for getting tax credits and tax deductions and the advantages of the tax credit versus the tax deduction. We talked about the more complicated ways of helping to save money, which is owning real estate and starting their own business. We also talked about the ability to take advantage of all the educational tools that are available for you from a tax standpoint. A lot of information to keep you busy.